Can we just start with the big drawdown? Can we call it that yesterday, the aggressive sell-off? Did you pick up the pieces this morning, Sam? How do you approach a sell-off like the one we had yesterday?
Well, I would approach it the way Tom seems to be approaching it. That is, when life gives you lemons, make whiskey sours. So basically, you look to history that... You know, history tells us that whenever we have had a 4% one-day decline, that we usually see a bounce of about 1% the day after. That's happened about 2 out of every 3 times. But then we sort of trade sideways for the next week as well as the next month before resuming an uptrend 3 months down the road. So basically, you know, I think investors just have to hold on to their hats right now.
Sam, I've been dying to talk to you about a concept I heard maybe 10 days ago, which is a lot of good ideas out there in common stocks, but you can't get scale. You can't buy a countable number of stocks. Do you at CFRA find that you've got a number of good ideas and then it's hard to find other good ideas?
Well, I think what you're finding is that as time goes on, you find that there are fewer and fewer companies on which you have solid conviction, because what our analysts do is they're looking 6 to 12 months down the road. They're not really looking for the next couple of weeks. And so, yeah, they take a look at the change in economic projections, in earnings forecasts, look also at momentum, and sometimes that list tends to get trimmed as a result. But we still have a solid count of stocks that we regard as being 5-star or strong buys.
Sam, how do you reject this idea that we're going to see an earnings decline that has not yet been priced in? This is what Wei Lee of BlackRock was saying, and this is what Mike Wilson of Morgan Stanley has put out there, that basically what the bond market is reflecting is work that the Fed is going to do that will essentially crimp the activity of a lot of companies.
Well, I think it's a logical assumption that that's going to happen. Traditionally, in bear markets associated with recessions since World War II, we've seen a 1/3 trimming of the PE ratios. But since the market tends to anticipate the end of recessions by almost 2 full quarters, we have to, in a sense, wait 2 more quarters into the bull market before we get a trough in earnings. Right now, we've already seen reductions in estimates. Q3 earnings are now expected to be up 4.2%, but on June 30th, they were expected to be higher by 10.5%. In terms of 2022 and 23 estimates, now we're looking at 6.8% for this year versus 8.9 at the end of June, and next year 7.4% growth versus 8.8. So we're already seeing a reduction in forecasts.
Sam, I'd love to squeeze this in, just a little bit more of a sector focus as Lisa digs a bit deeper. Financials, it was a big call at the start of the year. Yields are going up, rates are climbing, get into the banks, hasn't worked out. Energy now in focus for a lot of people. This Fed is set to crush growth. That's the fear that a lot of people have if they're going to carry on hiking interest rates by 75, 75, 75. Do I want to be long energy? Do I want to be long financials, given the expectations we've got off the back of that CPI report?
Well, historically, what you find is that consumer discretionary, technology, and financials are underperformers in a hefty inflationary environment, which is what we saw back in the 1970s. We are looking at financials that are trading at a slight discount to their long-term PE ratio, so about 5% discount, whereas energy is trading at a 55% discount to its average PE over the last 20+ years. So I would tend to say things are done more on a relative basis. And right now, on a relative basis, investors are gravitating toward the defensive consumer staples, utilities, as well as the inflation hedges of energy and, to a lesser extent, materials.